the what you call some of the benchmark treasury bills that were grabbed for you from FMDQ OTC Securities Exchange. And if you take a look at what the numbers look like, that's for the treasury bills for paper maturing 1st of June 2017 at 18.75, the yield 18.83, and that was 1.37% to the north. And look at the 2nd November 2017, and two of the papers, of the benchmark papers, maturing 4th of January 2018 and 5th of April 2018. And you can see the yields there climbing to about 22.32% for 2018, April, just about a year from now, in terms of treasury bills. Look at the flip side, and that's where you find the FGN bonds, the Naira bond, and you find the June 29, 2019 at 99 Naira 19 kobo at a yield of 16.42. It was unchanged. Same goes for the 18th July 2034, one of the long-dated benchmark paper, flat at 1591, and the yield on the 2036, 18th March, the year 2036. That's about 15 or 16 years from now. That will be this yield you see there, about 18.09%. So we have a lot to talk about the market, as it were, but let's look at the market with the stock market. That is quite a bit of a rally, and that makes market traders and analysts put them on a very happy mood, as it were. Positive sentiments. Chukwuma Anyanwu is the head of research at GTI Securities and is live with us here in the studios this evening to talk this over a little bit. Chukwuma, good to have you here.
It's great to be here, both.
Thank you. It's nice to have a very nice week where you have 10 earnings from some of the biggest companies on the market: Dangote Cement, Dangote Sugar, Julius Berger, and Zenith Bank. You think these earnings were major focus for traders this week?
Yeah, they were majorly responsible for the kind of movements we saw to the north of the market. And I think because of the relatively, well, very strong performances that each of these companies, most of them, turned out, we saw favorable market sentiment, people thronging back into these companies. For the projection of what they saw from first quarter, most people are already estimating that full year numbers will be very strong. So I think a lot of investors, particularly the high net worth ones, are already looking at full year numbers and taking positions.
So it looks as, well, things have been a little bit very nasty, as it were. But if you're looking at the year-to-date for our market, as we speak, at about 2.38%, not really bad if you're looking at we're just entering into the 5th month of the year.
Yeah, absolutely. It's quite impressive. Even though beginning of the year, for our outlook reports at GTI, we thought the market was going to end in the green this year. It was our expectation that there will be some moderate gain, nothing dramatic, but we'll see some moderate green close to the year. So I think the market is gravitating towards that side. And we've had some decent economic news. We've seen inflation beginning to downtrend, even though we're expecting the April figures for very soon. We've also seen the fact that our FX market is relatively stable. And so those things have given some impetus to the expectation for a positive close to the market.
When you speak to your investors, whether they come into the office or you pick up the phone and you interact with them, do you see a sense of a positive sentiment that, look, it's not fully, we're not really out of the woods, as it were, but it looks like there's a light at the end of the tunnel. Investors are looking at, look, perhaps something is happening from the fiscal side, and perhaps that will begin to trickle into the equities, looking at the companies, whether it's the financial services, banks, consumer goods, industrial goods, parts of the market.
Yes, absolutely. If you notice what happened with the unlisted securities exchange, for a lot of our investors, most of them will have their stock account for the unlisted securities and the equity security, the listed securities. So if you're looking at a situation where a lot of activities moves away from the unlisted to the listed, it means that people are looking at opportunities coming out from the market. And I think that's what is clearly reflected in the performance of the listed market.
If investors are looking positive, that means that they're looking at, look, hold on a second, our first quarter tends to look like, well, perhaps the full year will likely look good.
The thing is, I think the full year would look good for a lot of companies that have been able to remain resolute. For instance, in our view of the banking space, we thought that there would be a lot of positive momentum around the tier 1 banks, even though we are getting some very nice earnings surprise from the tier 2 banks. We thought, because of how big the balance sheet size is and their capacity to be able to absorb risk, a lot of businesses will be done around tier 1 banks. And that was clearly reflective of their performance in the Q1. But Q2 banks are also, tier 2 banks are also beginning to come to the table, and that's impressive. Even though we still see a lot of non-performing loans, which clearly indicates that they are not out of the woods yet, and which also reinforces our resolve that tier 1 banks are better areas to look at as far as cautious investing is concerned. It's refreshing to see that we are seeing that kind of drive from the tier 2 banks.
You talk about FX earlier on. It looks like if Naira gets a little bit healthier, investors seem to be more comfortable and say, well, maybe I should look at my stock portfolio once again. But if they get scared that the Naira is on a runaway bearish turn, perhaps they say, well, perhaps I just leave this stock there. I don't think I just want to have anything to do with it.
But what we saw with few year numbers for the companies, for most of, particularly consumer goods and oil and gas, was a situation where a lot of their input costs went astronomical. They were very high. So the major input cost for a lot of these manufacturing companies was the FX exposure. So if there was any form of stability in FX, it means that there will be a trickle-down effect from input cost to profitability. And that was what we saw in the Q1 number. So a lot of people would look at a stability in the FX market as a form of stability in the income.
In other words, if you pick up an annual report of a company as an investor, you're looking at the FX numbers now. That's what everyone is looking at.
The reality for Nigerian investors is this. We have become more savvy. Research has become more savvy because you need to pay absolute attention to certain things that ordinarily you didn't used to look at before. Now it's important for you to know what the exposure of each of these companies are to FX so that you are able to measure what risk factors that you're looking at in terms of how it affects bottom line profitability and ultimately dividend for full year.
We will have a lot more around the FX and outlook from some of the economists when we come back after the break. Chukwuma Anyanwu, who is the head of research at GTI Securities, is live to us here in the studios. We'll have more to talk about the economy and the markets after the break. Second part of the program. Don't go, we'll be back in 2.